Hello friends, in this video we will learn about the theoretical concept of valuation with solved example. If you like the video, please do share it and subscribe the channel. Valuation is defined as the technique of estimating or determining the fair price or value of a property such as building, factory, other engineering structures of various types, land. Use of valuation. By valuation, the present value of a property is determined. The present value of property may be decided by its selling price, or income, or rent it may fetch. Factors affecting value of a property are: structure of the property, life of the property, maintenance of the property, location, bank interest, legal control, supply and demand of valuation. Purpose of valuation. Purpose of valuation. I. Buying or selling property. When it is required to buy or sell a property, valuation is required. 2. Taxation. To assess the tax of a property, its valuation is required. Taxes may be municipal tax, wealth tax, property tax, etc. 3. Rent fixation. Rent is usually fixed on certain percentage of the amount of valuation. 6% to 10%. 4. Security of loans or mortgage. When loans are taken against the security of the property, its valuation is required. V. Compulsory acquisition. Whenever a property is acquired by law, compensation is paid to the owner. To determine the amount of compensation, valuation of the property is required. 6. Valuation of a property is also required if insurance, battlement charges, speculation, etc. Now we will see terms related to the valuation. Scrap value is the value of dismantled materials. For a building, when the life is over at the end of its utility period, the dismantled materials as steel, bricks, timber, etc. will fetch a certain amount called scrap value of the building. The cost of dismantling and removal of the rubbish material is deducted from the total receipt from the sale of usable material to get scrap value. For machine, scrap value is the cost of material only. Salvage value is the value at the end of the utility period without being dismantled. A machine, after the completion of its usual lifespan or when it becomes uneconomic, it may be sold and one may purchase the same for other purposes. The sale value of the machine is called as salvage value. Normally, scrap value and salvage value of a property or an asset get some positive figure, but sometimes it may also be zero or negative charge. The market value of a property is the amount which can be obtained at any particular time from the open market if the property is put for sale. The market value will differ from time to time according to demand and supply. It is also changed from time to time due to change on fashion, means of transport, cost of material and labor, etc. The book value of a property at particular year is the original cost minus the amount of depreciation up to the previous year. The book value depends on the amount of depreciation allowed per year and will be gradually reduced year to year, and at the end of the utility period of the property, the book value will be only scrap value. Rateable value is the net annual letting value of a property, which is obtained after deducting the amount of yearly repairs from the gross income. The value of property or structure becomes less by its becoming out of date in style and structure, in design, etc., and this is called obsolescence. The obsolescence may be due to the reason such as progress in arts, change in fashion, change in planning ideas, new inventions, improvement in design technique, etc. E.g., an old dated building with massive walls, arrangement of rooms not suited in present day becomes obsolete even if it is maintained in a very good condition. Annuity is the annual periodic payments for repayments of the capital amount invested by a party. These annual payments are either paid at the end of the year or at the beginning of the year, usually for a specified number of years. If the amount of annuity is paid at the beginning of each year, it is called annuity due. If the payment of annuity begins at some future date after a number of years, this is known as deferred annuity. Capital cost is the total cost of the construction including land, or the original total amount required to possess a property. It is the original cost and does not change, while value of a property is the present cost which may be evaluated by valuation. The capitalized value of a property is the amount of money whose annual interest at the highest prevailing rate of interest will be equal to the net income from the property. To determine the capitalized value of a property, it is required to know the net income from the property and the highest prevailing rate of interest. Now, capitalized value is the multiplication of net annual income to year's purchase. Year's purchase is the capital sum required to be invested in order to receive an annuity of Rs1 at a certain rate of interest. Further take look in the slide for formula of it. The fund which is gradually accumulated by way of periodic or annual deposit for the replacement of the building or structure at the end of its useful life is termed as sinking fund. The main objective of creating sinking fund is to accumulate sufficient money to meet the cost of construction or replacement of the building or structure after its utility period. The cost of land is not taken into account in calculating sinking fund as land remains intact. The amount of annual installment of the sinking fund may be found by depreciation may be defined as the decrease or loss in the value of a property due to structural deterioration, used life, wear and tear, decay, and obsolescence. Methods of calculating depreciation: straight line method, constant percentage method or declining balance method. Straight line method. In this method, it is assumed that the property loses or loses its value by the same amount every year. A fixed amount of the original cost is deducted every year, so that at the end of the utility period only the scrap value is left. Constant percentage method or declining balance method. In this method, it is assumed that the property will lose its value by a constant percentage of its value at the beginning of every year. Following are the different methods of valuation. Rental method of valuation. Direct comparisons of the capital value. Valuation based on profit. Valuation based on cost. Development method of valuation. Depreciation method of valuation. 1. In rental method of valuation, the net income by way of rent is found out by deducting all outgoings from the gross rent. A suitable rate of interest as prevailing in the market is assumed and year's purchase is calculated. This net income multiplied by YP gives the capitalized value or valuation of the property. 2. Direct comparison of the capital value method may be adopted when the rental value is not available from the property concerned. In such cases, the capitalized value of the property is fixed by direct comparison with capitalized value of similar property in the locality. 3. Valuation based on profit method is suitable for buildings like hotels, cinemas, theaters, etc., for which the capitalized value depends on the profit. 4. In valuation based on cost method, the actual cost incurred in constructing the building or in possessing the property is taken as basis to determine the value of property. 5. Development method of valuation. Method of valuation is used for the properties which are in the undeveloped stages or partly developed and partly undeveloped stage. If a large place of land is required to be divided into plots after providing for roads, parks, etc., this method of valuation is adopted. 6. According to depreciation method of valuation, the valuation of the building should be divided into 4 parts, viz. walls, roofs, floor and doors and windows, and the cost of each part should first be worked out on the present-day rates by detailed measurements. Valuation principles are: 1. The value of a commodity or an asset to the firm or its investors is determined by its competitive market price. 2. The benefits and costs of a decision should be evaluated using those market prices. 3. When the value of the benefits exceeds the value of the costs, the decisions will increase the market value of the firm. Time value of money and interest rates. In many cases, costs and benefits occur at different times. We must incorporate the time value of money when making a financial decision. This is the difference in value between money today and money in future. Also, it is the observation that two cash flows at different points in time have different values. Present value is the value of a cost or benefit compounded in terms of cash today. Future value is the value of a cash flow that is moved forward in time. Net present value is defined as the difference between the present value of project or investment's benefits and the present value of its costs. The law of one price. The practice of buying and selling equivalent goods or portfolios to take advantage of price difference is called arbitrage. Such situations where it is possible to make a profit without taking any risk or making any investments are called arbitrage opportunity. This concept is the law of one price. In competitive markets, securities or portfolios with the same cash flows must have the same price. A property valuation report is a document that provides a detailed assessment of the condition and value of an entire property. A property valuation report is given to the property owner to indicate the condition of the property, land, building, vehicle, factory, plant, etc., and how much it is worth in the market. Property valuation report includes following points. 1. Introduction or executive summary. A. Land particulars. B. Details of the property. C. Market. 2. Valuation summary. 1. Introduction or executive summary. The summary may include information such as the history of the property, its location, previous use, and other relevant information. This will give the reader a general idea of the condition of the property. In creating a structure for valuation report, it is ideal to use the method of discussing the important aspects first. After the introduction, general idea of the environment of the property's location is given. Overall feel of the neighborhood, the community is explained in detail, and also if it is located in a busy city or in rural place. Details of the property includes the description of the structure. If the report is for an existing building, the number of rooms and bathrooms, total lot area, number of stories, size of the garage and other details are included. Description of the pool may also be included if there is one. Improvements and repairs that are needed on the property are assessed. Some of the details that are included here are the date of purchase of the property, the price when it was purchased, mortgage details, and also tax details. It is required to be as detailed as possible in computing, so that the results will be accurate. 2. Valuation summary. This part summarize the property valuation report. The summary must contain the valuation of the property based on the previous details and computation that were done. Now take a look for solved problems. Specification describes the nature and class of work, materials to be used, workmanship, etc., and is very important for the execution of work. Cost of work depends upon the specification. It should be clear without any ambiguity anywhere. Only drawing do not furnish the details of different items of work, the quantity of materials, proportion of mortar and workmanship, which are described in specification. During writing specification, attempts should be made to express all the requirements of the work clearly and in a concise form, avoiding repetition. Clauses of the specification should be arranged in the same order in which the work will be carried out. Specification depends on the nature of the work, the purpose for which the work is required, strength of materials, availability of materials, quality of materials, etc. 1 General or brief specification. It is a short description of different parts of the work specifying materials, proportions, qualities, etc. General specification gives general idea of the whole work or structure and is useful for preparing the estimate. It also gives the nature and class of work and materials in general terms, to be used in various parts of the work from foundation to the superstructure. 2. Detailed specification. The detailed specification is a detailed description and expresses the requirement in details. The detailed specifications of an item of work specify the qualities and quantities of materials, the proportion of mortar, workmanship, the method of preparation and execution, and the method of measurement. The detailed specifications of different items of work are prepared separately and describe what the works should be and how they shall be executed and constructed. The detailed specifications, if prepared clearly, are very useful for execution of the work, so it is an essential part of contract document. Thank you for watching the video. If you like it, please do share it and subscribe the channel.